Welcome everybody. And actually it was really good just earlier meeting a few people that I'd met very, very long ago when we started this. And you've heard a lot of passion from the people on the front here talking about the businesses they're running. And it does sort of make me think back to, with Mercia, it sort of set it back up, 2010. And the whole principle of Mercia was to look at the capital, look at where the money is in London, get that money out across the UK and bring great businesses with capital and support. And that was at the heart of it. We co-founded that, an individual called Ray Chamberlain, a serial entrepreneur in the Midlands, 2010. 2014, we floated the business on AIM. We were turning over £700,000, just broke even. The two of us had sunk pretty much everything into this business to get it where it was. And we had approximately 30 million in terms of funds under management, which was our own capital and third-party funds. Today, we are 1.4 billion under management, a very profitable cash-generative business. I'll talk a little bit about that, and a balance sheet of about 200 million now. So it's a real pleasing journey, and I think we've absolutely proved that great things happen outside of London, and we continue on that journey. In doing that, my own background is in life sciences, actually, and as I said, I'm the co-founder of Mercia. About 18 months ago, we set out a thing called the Mercia 2020, and that was where we wanted to grow the business, frankly, by 20% per annum. We wanted to grow assets under management by 20% over a 3-year period. We're just over halfway through that, and to take the bottom line down to 20 million PBT per annum, and we're pretty close to doing that as well. So that's pleasing. The business itself, we've just bought a business just recently, so we've got about 400 million of free cash to invest across the group, and the whole purpose of this is to get the right type of money into the right type of business. And that could be, we invest anything from £100,000 to 10 million. That could be equity in venture, could be equity in private equity, could be debt, could be we invest in properties, we do regeneration. So a real broad church in capital deployment. And as I said, about a third of our assets under management today are in free cash, which is a great place to be. Our funds are not subject to redemptions, and what that means is we have closed funds. Typically our funds are 10, 12, 14 years in duration, which means we've heard a lot about long-term planning, is that we can support our businesses and have a 7-year and 8-year opinion on their growth and supply the capital along that. That's really critical as people are growing their businesses. The portfolio of businesses that we invest in are ones that we do invest alongside others, but if those others decide that the economic time is not right for them to invest, we make sure that those businesses, we can invest them in our own right. So we typically only back businesses that we can, if we need to, support with our own capital needs, and that means that we have a very resilient business through the different economic cycles, I think, which is important. In terms of NAV per share, so the net asset value per share, which reflects the strength of the balance sheet, 46.8 pence, and that's growing, continues to grow. When we floated the business, I remember talking to our shareholders at that point, the ambition here was to have a capital growth model, an operating, profitable business that's generating cash and serving a progressive dividend. I'm pleased to say we're into our 2nd year now of that progressive dividend place. Our fund management operation more than covers our dividend. So we're in a good place in that regard. Really important to look at that map. And I don't know if, Jan, you hit brilliant, excellent. So the whole point of this was, okay, if we're going to go out across the UK, we need a physical presence. We need to be within a couple of hours, ideally, of the businesses that we're supporting. We have 9 offices, as you'll see, across the regions there. Our office here in Bristol reaches into Wales. Our office up there in Newcastle, which is why I asked if Jan was here, reaches into Scotland. And Jan, if you've got business opportunities, prospects, people that are looking for money, Jan's your man at the back there, and he's here to have those conversations with you. The model is quite different. It's quite unique in what we do, because we're not a balance sheet investor and we're not a fund manager, we're both. And so we have a profitable fund management operation on the one side here. That's growing, it's profitable, it's scaling. It's about 1.2 billion now in third-party funds under management. And then the proprietary capital, that's our balance sheet money. It started off with Ray and my money, and now it's expanded since that. That money there is really to fulfill 3 purposes. First one is to invest in funds in areas that we want to grow. The second one is actually we invest in some of the businesses in here. We've got about 600 companies now that we've supported through our funds. There's about 20 on our balance sheet. All 20 on our balance sheet have got funds positions in them as well. And the third one is to make acquisitions. And we have been acquisitive over our journey as well, and I'll talk a little bit. And so we bring those 2 things together, and that's what's providing the capital growth in terms of the balance sheet performance and the yield in terms of the profitable, well-performing fund management operation. And that was our desire when we floated back in December 2014, and I'm pleased to say for the last couple of years, that is where the business has now progressed to. We follow a very strict regimen in terms of acquisitions. We are a domestic investor only. We're very focused on the UK, and we look at acquisitions. We heard about time. We look at acquisitions which compress time. I'm impatient for growth. Time is the enemy, frankly, of us all. So the acquisitions have to compress time in that respect. We bought our first business in Enterprise Ventures, one of the most active investors in the north of England. It was a great way of leapfrogging forwards. And to put that into context, our assets under management, our funds and our balance sheet, but the funds in particular, about half of those funds have come through acquisition. Then when we make the acquisition, the other half comes from organic growth from that business. So we are looking at these businesses as the next step for organic growth. That's why we acquire those businesses, to grow in that regard. And we follow something we call the value driver analysis, which is something really dear and important. And often Martin Glanfield, Mercia's CFO, is up here and he will talk very passionately about the value driver analysis. And that is where the execs get together in a room and have to show 20 defensible reasons why you would buy that business. All four have to put it down and then we present it to the board. If we cannot come up with 20 clear reasons for buying a business, we don't buy the business. So that's a really important discipline as we go through that. We look for a lot of reasons for buying it, but actually if there's not a cultural fit, we won't do it. Strong cultural fit between the acquisition and between what Mercia has been trying to create and continues to create is critical. So cultural fit is the number one reason. Second business we bought back in 2019 was the VCT fund management contracts from MVM. Acquired that business, and you can see a sort of multiple consistency in terms of what we're paying for these businesses. And actually we bought a business in December, just gone, business called Frontier Development Capital, FDC, fabulous business actually, which does lends debt and it also looks at property development in terms of regeneration, brownfield sites, etc. Acquired that business and fully integrating that business as we speak. Birmingham based and to north of England. Again, speaks to the point that we're reaching across the UK here. Just a little bit, which I've just spoken to. I think quite importantly, if you look at this, we bought this with our own cash. So what we're not doing is going back to the city to raise money. We're generating cash. We have the cash. We'll make our acquisitions within our own means. And that's really important. You'll see our share register in a moment. That really reflects that journey that we've been on, which has completely changed over the years we've been on the market in that respect. I think it's just worth pausing because this is about organic growth. So this is about where the growth comes from. Because you've heard from all the other presenters, what we're trying to do here is create a business that is scalable. We are collectively trying to create a business that is scalable and that has operating leverage. So as you grow the business inherently with scale becomes more profitable. That is the fundamental thing between any leader trying to do. What we have here are three pools of capital that we look on an organic basis when we're looking to scale the business. So retail capital, we manage enterprise investment schemes, EIS, venture capital trusts, VCTs, really important parts of capital deployment, tax-efficient capital deployment, which a number of you may well be using in terms of supporting the sort of small to medium-sized enterprise base across the UK. Approximately 1.6 billion, 1.1 billion total market, what was raised in the latest published figures. And we manage in EIS, I guess 50 million, and in VCT about 400 million. So we have a long way to go in terms of growing that opportunity. So really nice market that we're serving well, and a market we think we can greatly scale. The second part of our business in terms of organic growth are almost like public sector, pseudo-public sector funds. Now, British Business Bank and others like British Business Bank are there to try and stimulate growth within the regions, and they have these regional funds. The first generation of those regional funds were across the Midlands and the north of England. We manage 40% of those. That's not what we weren't expected to be quite so successful at the bidding of those, but that's fabulous. And those are venture and debt funds. The next generation of those have been announced, and actually they're now starting to come out to tender, and they are considerably more in terms of their size. So now you've got something like 1.6 billion being committed to the regions, and those regions are no longer just the North and the Midlands. And for this audience, you'll be pleased to hear it's Scotland, the North, Midlands, Wales and South West. So that is a scheme that's rolling out, frankly, across the country. And we, of course, will be bidding for those again. So really important to us for those to secure an amount of that. We won't get 40%. 40% is amazing, but we won't do that again. But we will be aggressively bidding for those. And the final port in terms of pool of capital that we manage is institutional capital. And those are regional pension funds where they're allocating it actually on what they call an impact basis. So they're looking at supporting the region that they're in. So if you're Greater Manchester Pension Fund, you're the local authorities within the Midlands, your West Yorkshire Pension Fund, you're allocating capital to support that region. As a regional investor, that plays really well to us. And so again, we manage private equity and debt through institutional capital. So those are three discrete pools of capital, but actually they all have a very strong similarity, as in their long-term capital. This is evergreen. And these are the 10, 12, 14-year pools of capital. So again, remaining really focused always within Mercia, domestic, long-term capital, and support. And I pointed out Jan, but there are 144 people at Mercia now across those 9 offices. Many of us have got very deep sector knowledge. At Mercia, I'm very privileged to be my third business that I've had the privilege of growing and moving along. A lot of us have a lot of familiarity in growing young businesses and scaling them forwards. And we try and bring that wisdom and support to the businesses. We have a thing called Mercia Nucleus, and that sits, we take a board seat on our equity businesses. We will sit there, and if they need new NEDs to be added to it, they want to build out the management team, we'll do the search. We have a searching facility. We'll get people from within our network. And we do that for no cost, because it is in our interest for those businesses to grow, and so we will help those businesses grow. So the capital and our expertise and regional reach is probably a strong differentiator compared to the rest of the people operating there. What this shows is how we divide our capital pools, and importantly, our portfolio going across. And I'll talk a little bit about the activity we do. We're doing something like 10 to 15 investments a month. So we, I believe, are now the most active investor across the UK, which is a real pleasure when you start off with 3 of you and you have an ambition to suddenly find yourself there. So that's great to go. A lot more for us to do. I think this liquidity is important. You know, a fund manager with no cash is a failed fund manager. You know, liquidity is really critical. So free cash, this is unrestricted. So this cash is there to draw down and invest. Really, really important. Hence our desire to continue in terms of our active investment and deployment. So this is where Martin would spend his time talking through the numbers, and I am not going to pretend at all that I know that much about the detail of the finances. So I've taken his summary slide only. But what I will say is if people want to see the detailed financials of this, of course it's all on our website. All of these numbers talk to our interims that we posted in December. The numbers are there to see. I think the principle here is just reminding you when we started our journey with a sort of 700,000 business break even. In the 6-month period, 12.2 million in revenue, operating profit for those 6 months, 3.6, that's from the profitable fund management business, so pure cash generation. Profit from the balance sheet added in terms of its performance, so those assets when they're selling. We just sold a business called Intechnica. We sold that for double our holding value. Last year we sold Fradian. The year before that was Oxygen. And these businesses are bringing 30, 15 million back to the balance sheet of cash. These aren't fair value movements. These are cash returns back onto the balance sheet. So strong in that regard. As of our results in September last year, unrestricted cash position of 56 million. So that's cash on our balance sheet, which is why we don't need to go out and raise funds. It's why we can go and buy an FDC for 10 million quid, because we've got the cash on our balance sheet to do it. NAV per share, 46.8. And what that represents is the value of our direct investments. I'll talk about that in a moment, about 130 million. The 56 million of cash, and then the delta is the intangible assets. So balance sheet of about 200 million. This is a share reg that I was talking about, which I think is pretty exceptional. First thing to note, of course, is that every single employee, the 144 people in Mercia, are all option holders. It's something that's been very important to me in my previous 2 businesses. Important to me now is that everybody should have a stake in the business that they're, frankly, putting their life into. A lot of our employees have invested their own money and bought shares as well. The board, employees, management own about 17% of Mercia. And I think that's a really important sort of statement that, you know, we're on a mission here and we want to own part of that mission. But then you look at the shareholders, the register there, that for us is something to be really proud of. You know, BlackRock, Fidelity, Columbia. We've got some very good shareholders there, long-term shareholders there, that have joined us on our mission going forwards. And you can see, of course, West Yorkshire Pension Fund, we manage some of their capital in the private space as well. So again, really pleasing to see them join us on the share register. So, the investments. So this is to do with the group investment activity and the balance sheet investment activity. We see I say we, Jan, and people at Jan are seeing something between 2,500 and 3,000 businesses a year. We're seeing about 65% of all businesses looking for money across the UK, we get to see them. So there's still work to do, but we're seeing a lot of them. And the business plan's coming through. In the 6-month period, we invested 56 million. We're typically investing 110 to 130 million a year in businesses. 80 invested in, 35 new to the portfolio. So that says two things. Firstly, and actually, we've talked a lot about COVID. We didn't stop during COVID. We made the strategic decision during the COVID outbreak to up our investment activity, not to down it. So we invested in those businesses without even meeting face-to-face the management team, without going to their offices or premises. We decided, and we're so pleased we did that because they're just excellent businesses. When everybody else took a step backwards, we took a step forwards, and that meant we got to see almost the whole market, which was brilliant. The 80 and 35, what that says is that we are continuing to support existing portfolio as well. So these are not one-off transactions. We back a business, typically it's a loss-making business, and we know for sure in about 18 months' time they'll still be loss-making and still want money. So we're there to continue to support good businesses and help them on their journey. And we are always looking, the 35 says, we're always looking for new deals as well. What can I pull from that? One thing I think is important, actually, and for those of you who are private investors, you'll probably be noticing, is that I guess in the last 2 years, it has been the most remarkable time in terms of exits. I think we returned 155 million up until 2022. So we have returned something like a quarter of our assets under management in cash to our investors in our funds. We've reduced the amount of portfolio, and at the moment we're rebuilding the portfolio. What we've seen a slowdown in is IPOs, trade sales, exits of any kind really are slowing down at the moment. The market is cautious. That will pick up again, but it might not pick up for a year or two. For us, that works well with the cycle because we've got capital to invest and we need to rebuild the portfolio. But in terms of exits, there's definitely been a change in the market in that respect. Can't be in Scotland without talking about our Scottish investment activity as well. So we've invested about 28 million across Scotland. We work with universities. So we have something like 12, 13 university partnerships, and about 5% of all our investments are into university spin-outs. So we've got university spin-outs in here. I mean, DX Cover is Strathclyde, Invisius is University of Edinburgh spin-out. So we've done a number of university spin-outs. Napier, we've done one as well. And a broad church in terms of sectors. We're very keen to have a broad sector spread because these sectors come and go in fashion, and therefore we don't want to be overexposed in any one sector in that regard. And you can see that snapshot there in the Scottish businesses we've done, which reflects across the broader UK. These are our balance sheet assets, as I said before, 131, 132 million of total value from the balance sheets. You can see there's a broad spread of age and a broad spread of value. These next two slides just show a couple of points that's worth bringing out. First one is you'll see that the balance sheet owns a big chunk of these businesses. So if I just remind you of the model, we've got the funds and we've got the balance sheet. So this is the balance sheet ownership on its own. So we own typically 20, 30, 40% of the businesses. There's a thing called shareholder, this is where Martin will take SSE, can't remember what the acronym stands for, but it means if you own over 10%, it's a very tax-efficient basis for when you sell those businesses. So we always look to hold at least 10% of a business on our balance sheet. Our funds are also owning 10, 20% of these businesses as well. So although we don't control the businesses, we have a strong influence over them, yes, but actually this reflects our continued support for them. So we will continue to support these businesses, hence the climbing equity stake, over a broad range of businesses. Endreams is a VR developer. The Ghostbusters VR game that's just come out, Endreams did that with Sony. So business really growing fast. Impression Tech is an aluminium pressing business. Netasia, cyber attack, cyber bot business. And so it goes on and on. Vertrade has changed its name, but Vertrade, which is the end one, is a gaming business. So quite a broad church here. Warwick Acoustics is amazing because this is a business we've backed for a very long time, since 2014. If you can imagine a piece of card, that's the thickness of their speaker, completely flexible, completely shaped. It's now being designed into 3 cars, 1 hybrid, 1 oil, 1 electric vehicle. Those will be coming out soon, very soon. And so that's really pleasing. The University of Warwick spin-out takes time, but it's really pleasing to see these things coming through now. These are other investments that we've just recently added to the balance sheet. Axis Spine, that's an A-lift, so hopefully nobody of you got this, but if you need vertebral column stabilising, straightening, repairing, they've got what's called anterior. So it comes in actually anterior is at the front, posterior is traditionally at the back. Really exciting. We've backed that business all the way up to FDA approval. We've just invested alongside our VCTs, alongside our EIS, our own balance sheet money, and a US investor to roll that out following the FDA approval it's got across the US. We expect that to go very well. Nova, bioethanol, predominantly working with British Airways for bioaviation fuel, and Unify is working at curved surfaces to sort of control mechanisms, etc., within the home and within the automotive. So 3 very different areas, but 3 very exciting areas. Penultimate slide, because I've just seen the timer. So this basically shows our holding values and what we sold our businesses for from the balance sheet. So back to the balance sheet ones, you saw the holding values. Every single business that we've sold above the holding value. These are all cash returns coming back onto the balance sheet. Add them up, average 45 million, 69 million. In other words, about 50% the holding value is what we're selling these businesses at. And that's really important, actually, to make sure you're holding these things below value, not above value, because fundamentally your valuation of your business is pegged to this. In summary. So in summary, the acquisition we made, earnings enhancing, fabulous business, 400 million of debt comes on to us, and that's not our debt, that's third-party debt in terms of debt fund deployment. As I said before, the 2020 is deliverable. These funds are long-dated, so we have confidence for our portfolio that we can continue to support them not over the next 12 months, but over the next 5 to 7 years, for instance. Very diversified portfolio. 2% fee margin across the capital we manage, so very profitable business in that respect as you scale FUM, and the liquidity, over 400 million, it's about 450 million now, of free unrestricted cash to invest going forwards. Thank you very much for all of your time.
Thank you, Mark. Any questions in the room? Oh, one over here.
So do you see the funds you've got available? Sorry, do you see the funds you have available to invest, being invested in the near future?
Yeah, so I would say we've got 2 to 3 years of investment capital. So if we were to raise no more new funds, we've got 2 to 3 years. But we are raising new funds almost every 4 or 5 months. So yeah, and actually we can see, based on 2,000 business plans coming through, we're confident we'll deploy that over the next 2 to 3 years.
And also the dividend, do you see that being increased? Or?
Yeah, we deliberately refer to it as a progressive dividend because it has been progressing and going up. It's about a 2% yield at the moment. So yeah, we would expect that to continue to rise.
Excellent. Any more questions in the room? I had a couple of questions, Mark, if that's okay. So one was, what is the kind of failure rate of businesses that you invest in?
That's a good question in as far as there's no one answer.
Right, okay.
And the reason is, if you look at the managing directors across venture, private equity and debt, Tabs would say in debt, my failure rate is 0. I cannot afford, I'm lending this money and therefore I'm going to due diligence to make sure they can pay it back.
Yeah.
Whereas Wayne will say, I've got a portfolio of 10, maybe 1, maybe 2 at the most, but that's it. Whereas actually if you went to Pete or you went to Julian within the venture, they say, well, 70% are going to fail to return my investment. Therefore, my returns come from 20 to 30%.
Sure.
The balance sheet looks more like private equity.
Right.
And the balance sheet comes in at a later point and so has much more of a sort of private equity mindset to make sure, failure rate, not good thing. But our venture team, which is the lion's share of what we do, has a high risk appetite.
Yeah.
You're looking to get 5 to 10 times your money back, and therefore you can afford that failure position.
Great. And in terms of the balance sheet profit, is it fair to say that can be quite lumpy, like looking at...
Yeah, and that's why we separate operating profit from the bottom line,
Sure.
Because the operating profit is the thing from the fund management operation, which is consistent and climbing, and that's covering basically... We don't say dividend cover, but that clearly is supporting the dividend going forward. The balance sheet, we're not in a rush to sell those businesses. We'll sell them when it's the right time, and that means inherently it's lumpy.
Sure.
But that's why, when you've got 50 million on your balance sheet, we're always focused on making sure that that's a reasonable sum of money, so we can slow down our balance sheet investment activity to make sure we have a good, strong cash position on our balance sheet.
Excellent. Right, time for one more question if there is one in the room. Otherwise, we'll leave it there. Thank you very much, Mark.
Thank you.
Appreciate
Thank you
it.
very much, everybody.